What's up, millennials? Welcome to part 4 of this series about investing for beginners. So in the last few videos, we talked about ways to spend less money and earn more money. And then we also looked at different ways to use that money. We looked, for example, at the difference between saving and investing, and we saw that historically seen, investing has always been more profitable in the long term than saving your money. Now, many people ask me, if I do have money to invest, can't I just go to an investment fund so that they can manage my money for me? Because, well, I don't have a lot of time to invest and I don't really know a lot about investing either. Well, in this video, we're going to talk about the disadvantages of investment funds. And in the next video, I'm also going to show you how easy investing can be nowadays. So let's do it. So what are investment funds exactly? Well, basically they're like groups of people who invest your money for you. So what you do is you simply go to them and you give them your money and they invest it for you. And in exchange for that, you need to pay them a fee. In this video, we're going to be talking about 3 disadvantages of investment funds. So first of all, we've got fees. Second of all, they're not much better than the average stock market returns. And third of all, you don't have a lot of freedom. For today's examples, we're going to be taking a look at an investment fund called Robeco. And as we can see on their website over here, Robeco is an international asset manager offering an extensive range of active investments from equities to bonds. All right, all good. Then we can see over here that Robeco has 155 billion euros in assets under management as of June 2020. And they have developed high yield investment strategies. They invest in emerging markets. So that's pretty much a very quick summary of what they do. Now let's talk about the first disadvantage, the fees. On the website of Robeco, we can see a few funds, and let's just take a look at one of those funds, for example, Digital Innovations right over here. Let's just select the first one. And then what we're going to be looking at is, the funds. So we're going to go ahead here and go to Detail and Costs. And then here we can see that this fund deducts ongoing charges of 1.71%. And basically that's a management fee of 1.5%, which you need to pay to the asset management company for the professional management of the fund. And then there's also a service fee, which is intended to cover official fees, such as the cost of annual reports, annual shareholders meetings, and prize publications. Now keep this percentage in mind for a second, okay? 1.7% more or less. And let's go back to the calculator that we had been using in the previous video. We were calculating how much money we were able to earn with investing. If we started with an initial investment of 5,000 euros with an annual interest rate of 9.7%, which was quite average for the last 25 years, as we've seen in the previous video, an annual inflation rate of 1.5, years of growth 25, and we invest 200 per month. Now let's assume that you are investing with Robeco. You are investing with an investment fund, and they take 1.7% of the annual return that you make. Now with these numbers over here, the future value of our portfolio would have been 219,000, okay? Keep that in mind, 219,000. Now, if we subtract 1.7% from the 9.7%, we would be left with 8%, right? And now the future value of our portfolio drops to 167,000 euros. So first, the future value of that portfolio was 219,000. Now it's 167,000. That is a difference of more than 50,000 euros. So that's already a pretty major disadvantage if you ask me. So the second disadvantage is that they are not much better than the market, or even they sometimes are much worse than the market. Let's see, for example, what the performance of this exact fund has been over time. And for that, we're going to be going to this tab over here, Performance. We can see the graph over here since about, well, October 2017. And we can see that it has been going horizontal for quite a while. It has been going up. But then let's take a look at the performance year to date, which can be found over here. The performance year to date as of the 31st of August was 5.8%, okay? 5.8%. Now let's take a look at the graph of the S&P 500. This is SPY, this is an ETF that tracks the S&P 500. And let's do exactly the same. Let's say, okay, this is the 2nd of January, so pretty much the start of the year. And let's go all the way to the 31st of August, which was around here, okay? And as we can see, according to this graph, the S&P 500 was up 7.5%, which is better than the 5.8% of the fund we have just been looking at. And now let's check out the graph for the Nasdaq as well, which can be found over here. Let's do exactly the same thing. So this is January, the 2nd of January, pretty much the start of the year. And let's go all the way up to the 31st of August, which is right over here. And as we can see, the Nasdaq went up about 36% in the same time. So that's a pretty insane difference if you ask me. So that's the second disadvantage of investment funds. They're not necessarily better than the stock market, or even they are sometimes even worse than the stock market. And then the third disadvantage is that you don't have a lot of freedom. What do I mean? Well, let's take a look at what this investment fund has to offer. Let's take a look at their portfolio right over here. We can see the fund allocation, which is 96-97% almost in equity and a little bit in cash. And then if we go to the top 10 holdings, which are right over here, we can see the top 10 biggest companies of this fund, which are Microsoft, for example, Siemens, Schneider Electric, Accenture, etc., etc., etc. Now, first of all, when I was looking at this for the first time, I was thinking, well, these don't really seem to be companies that should be in a digital innovations fund. These are companies that are very different from the ETFs that are offered by ARK Invest, for example. And when you are a little bit like me, well, you might think, I don't really want these companies, I just want different companies. But the problem is, if you go to Robeco and say, well, I would like to invest in digital innovations, you cannot simply say, well, I don't want this company. They are going to make the decisions for you. You cannot decide which companies should be in that fund. So that's a big disadvantage for a person like me. Apart from that, if we take a look at the dividend policy of Robeco, we can see something interesting as well. Right here it says that the fund does not distribute dividend. The fund retains any income that is earned, and so its entire performance is reflected in the price. So if I interpret this correctly, you don't get regular dividend payments. What they do is they simply put the dividends back in the investment fund. And this might be a problem for people who would actually like to have recurring passive income based on the payment of the dividends. Then what happens when you do decide to invest for yourself? Well, if you pick all the stocks yourself, you are in full control. You choose which companies you would like to invest in. You choose if you want to invest in dividend companies or not. And you get paid recurring passive income because of the dividends that are paid by the companies. So there you go. 3 of the biggest disadvantages of investment funds. And at the same time, 3 of the most important reasons why you should start investing yourself instead of letting other people manage your money for you. In the next video, we're going to talk about one of the easiest strategies that you can apply to get started in the stock market. So I hope to see you there. See ya!